Good evening. My name is Heidi White, and today I'm going to discuss capital budgeting and using sensitivity analysis tools. Qualitative and quantitative information can be used to make investment decisions and calculate risks. What is capital budgeting? Capital budgeting are the choices a business manager will make to use capital, funds at the manager's disposal to allocate towards debt or equity. The goal is to make more money than you spend, and the analysis tools that we'll use are quantitative and qualitative information. What is sensitivity analysis? It's essentially how the business manager forecasts the success of a business based off of current data and how they can modify the variables to predict alternate outcomes and determine if the company is worth investing in. So how will we evaluate the risks? Well, first we're going to look at qualitative steps. Input variables. That's the different values or scenarios you manipulate to determine possible outcomes. Cost of goods sold. That's to input the current cost of the materials or contract arrangements for wages or labor. Capital costs. Current cost estimate of equipment or maintenance. Cost of new hire product management. That's a cost analysis of the industry standard or internal assessment of current positions. Market research. That's determined by the manager's or shareholders' current priorities. That's money put towards focus groups or test marketing to determine what strategies to use to garner sales. Continuing value. There's explicit forecast period. That's a forecast of the financials for the next 6 years. That's insufficient, so we'll need the post-horizon period. That calculates the discounted cash flow analysis into the marketplace value of the business after 10 years. For qualitative steps, we'll use the scenario manager what-if analysis in Excel to create potential outcomes. But be sure to start with a base case and save. This will allow you to create worst best case scenarios and other scenarios that may change how the shareholder will allocate expenses. So now we'll move on to the quantitative steps. There are 4 major areas to consider. Quantitative steps are business analysis based on math and statistics. We'll start with market potential first. What's the current size? What is the current market demand for the product? Growth potential. It's a sales forecast for the product over it. What is the sales forecast for the product over its life cycle? Competitive environment. There's product alternatives. Do you have competitors in the market? Pricing. How does the competition price their product? Do you have to match that pricing? And costs. How does the competition invest in the expense of their product? And do they have more economical means of producing the product? Profitability. If you price lower than the competition, can they meet your price and still turn a profit? And then the competitive advantage. How might your competition block your success? Moving on, we have marketing costs. Do market research. How do you know the product will make money? Historical data, other companies' product success. Are you able to obtain the data, and how much will that cost? Distribution channels. How much will it cost to store and distribute? Consider discounts to repeat customers. Promotion and advertising. How much it would cost to expose the company and products to customers through print, online, radio, television media. Is there a cost to develop that? Rollout and implementation. Cost of training sales team on product, cost of meeting with potential distributors. Product cross-elastics or cannibalization. Will the new product affect the sales of your existing products? And objectives for market share and penetration. Examine if pursuing growth or pushing for total inventory sellout is required to make a profit, or if that's flexible. And the last area is operational and customer service costs. So technology, do you have what you need for your product? or do you need to develop or purchase it? Systems. Do you have the personnel and products you need to manage your product sales? Billing and collections, inventory, and the financial management software. Implementation plans. Do you have the staff you need to meet your rollout and production timeline goals? And training. Do you need to train sales personnel and customers on the product? Do you need to develop training materials, and how do you plan on communicating the training? For quantitative steps, Excel can't create the business case. So how do you analyze a business case for quantitative data? By providing data or numbers in order to create statistics. So it's a big advantage and disadvantage for this. An advantage, the data will allow you to forecast possible outcomes by manipulating variables. Very simply, you can choose to invest in a product or pass on it based on the capital budget scenarios. Disadvantage, you just don't know what you just don't know. There's always going to be a risk. So this concludes my presentation on capital budgeting. We discussed sensitivity analysis and the qualitative and quantitative steps we use to analyze. Does anybody have any questions? Thank you very much, and you have a very good night.